FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry, Lutz, and John Rubino is with us for our usual Monday chat. And he's written a couple of very timely articles. Don't forget, you find him at dollarcollapse.com. He is co-author of the best-selling book on Amazon, The Money Bubble, along with James Turk of Gold Money. So the first article is Greece is fixed. Oh, wait. And, well, Greece got 4 more months of life support. And John, so everything's fine, right?
Hey, Kerry. Yeah. The new Greek government started with such high hopes, and they were going to stand up to the Troika, and they were going to insist that the weight of all the debt that has been imposed on Greece and all the bailout terms that were really onerous were going to be lifted, and they were basically going to solve their problems by doing away with austerity. Well, they completely lost the negotiations to Germany. They basically got steamrolled, and they've ended up having to agree to pretty much German terms. So as of the end of day Monday, they were supposed to come up with a set of goals that they would pursue over the next 4 months in return for getting some leeway on their loans, so they wouldn't have to make good on their debts immediately. And they weren't even able to do that on the end of the day Monday. They announced that they would be a day late coming back with their proposals, and this then depends on Germany agreeing to them. And it sounds like the Greeks are trying to demand some of the Socialist Party platform that they got elected on, which is higher public sector pay, more generous pension payouts, things like that. And the Germans aren't going to go for that. So we don't know for sure that this is a done deal. As unfavorable as it is for Greece, they might not even get it. So we'll see what happens on Tuesday. But whatever does happen on Tuesday, the ultimate result of the near-term negotiations is going to be a can-kicking exercise. They'll delay this for a while, and nothing will get done, and then it'll come to a head again in 4 months, and then another. Greece is really unfixable within the Eurozone, and that's the takeaway from all this, is that they owe way too much money. And unless they get rid of that debt somehow, there's nothing that anybody can really do to fix Greece's economy, because having to pay off that debt, which requires them to run a budget surplus before interest payments, means that they'll probably be the only major economy running a budget surplus.
This is never going to happen.
It'll never happen, yeah.
When donkeys can fly, that's when, who are we kidding here? This is absurd. And this is like a serious negotiation?
Well, we have to understand that the Eurozone is kind of schizophrenic right now. The people in charge have 2 very strongly held sets of opinions that are mutually exclusive. They want a common currency, and they want everybody to operate under the same rules. But at the same time, they want to keep their national identities, which require them to operate under slightly different sets of rules. The cultural reality of Greece and Spain and France is such that they can't operate as Germany. They can't operate under Germanic rules of thrift and efficiency. It's just not the way these cultures are designed by their histories and by their temperaments. So one of 2 things has to happen going forward. One is that they do coalesce into one society under largely Germanic rules. So they're sort of like the United States, where France and Belgium and Spain are states within a country that is run by a federal government that's dominated by Germany. Okay, that's one possibility. The other is that they break up. They realize that it wasn't going to work, and they cut their losses, and the Eurozone dissolves. And see, either one of those things requires a huge change in attitude and perspective on the parts of the people involved right now. And so they're not ready for either one. and so what they're trying to do is find some middle way where they continue as they are today and insist that the member states in the Eurozone adhere to the Maastricht Treaty, which required them to hold their budget deficits below 3% of GDP. And I forget what the total debt limits were, but it was something like 65% of GDP. They weren't allowed to carry as much debt as most of them currently carry, and they weren't allowed to generate the deficits that most of them currently generate. So they're paying lip service to Maastricht and trying to get back there, but it's more and more clearly impossible for them to get there. And so what they're doing now is relying mostly on monetary policy, where they're going to ask the European Central Bank to continue to buy back debt and to pump out huge amounts of new currency and shovel it into the banking system and hope that extremely low interest rates and extremely easy money will get the economy moving and allow them to generate enough tax revenue to get back within the strictures of the Maastricht Treaty. And, it's highly unlikely that happens because we're 5 or 6 years into a recovery now. This is usually the point at which a recovery ends temporarily. This is as long as they usually run. And so if they can't do it now in the 5th or 6th year of a recovery, then how are they going to do this a year into a recession, which is probably what we'll see sometime in the next 2 or 3 years? We got another recession coming just because they normally come after the stock markets hit records and the economy's been growing for a while. And, in the U.S., reported unemployment, at least, is at levels that usually precede a downturn because we've been going for 5 years. And so it won't work. And maybe Greece is the straw that breaks the euro's back, or maybe it's Italy, or maybe it's Spain. These guys all have fundamental structural problems that begin with them borrowing too much money and continuing through really, really oppressive labor laws that don't allow small businesses to start and grow and innovate and hire new people. The dynamic in the U.S. isn't great anymore, but it's still vastly better. It's vastly easier to start a business here than it is in most of Europe. And so they don't have that job creation engine, which means they can't generate the kind of tax revenues that their governments need to manage all the programs that they've taken on. And so, it's a mess. And it ends one way or another. I think it's highly unlikely that they end up with a German-dominated federation where Germany makes all the rules and everybody else lives within those rules. But that's the only thing that would keep the system together. And so the alternatives are some kind of a breakup, whether it's orderly or messy. And it's likely to happen in the next few years just because we've reached the point where, you look at the debt levels for Italy or Greece, and they're almost at Japanese levels, which is to say bordering on crazy, impossible to maintain. And therefore they won't be maintained. So one of these guys blows up, and it's hard to know which one does it first, and it's hard to know when it happens, but it's virtually guaranteed that something like that does happen. So that's why Greece is so interesting, because it could be the first. Greece is the test case. How do you fix an over-indebted country in the Eurozone? And it's turning out to be impossible because the Greeks had an idea: do away with austerity, go back to aggressive government hiring and spending, and try to grow their way out of it that way. Well, that didn't work. That wasn't allowed by their German overlords. And so now they're going to go back to austerity, which is the same thing as saying depression as far as the eye can see. And so the question going forward is, will the Italians put up with the same thing? It's a much bigger country, much more able to impose their own will on the situation. So maybe Greece will just be locked into a depression forever, and then Italy will be the test case. We'll see. Either way,
remember that when Greece asked what they should do, I don't remember if it was a German, but somebody said to them basically to start selling off islands.
Yeah.
That was the solution. Just dissolve your country.
And
liquidate.
that was part of the program that Syriza, when they took over, stopped cold. There were a lot of privatizations in the pipeline, and the new government said it wasn't going to do that anymore. They were going to keep these assets for the people, for the state. And it's not clear whether they've had to go back on that also, and they're going to have to restart the privatization process as part of capitulating to Germany. That's still being decided and reported, and we don't know yet exactly what they're going to have to do that they said they wouldn't do. But it's most of what they said they wouldn't do. That's pretty much baked into the cake right now. And so we're just at the margin now and deciding whether it's going to be 80% walk back from their campaign platform or a 100% walk back. And we'll know a lot of that tomorrow when we find out what they propose and what Germany accepts.
Not going to be pleasant for them, and they're going to wind up getting booted out like the other government, right?
Well, well, if they can't make good on any of their promises, then you got to figure that the next election, and who's left? I think only the neo-Nazis are left who haven't been tried yet.
They'll show them.
Yeah.
They'll show them how it's done.
Yeah. Yeah. So I don't know. And it all comes back to a badly designed common currency and the propensity on the part of most of these countries to borrow way too much, like the rest of the developed world. Yeah.
And remember, Goldman Sachs did have a little bit of role in helping this thing be put together by helping them hide a lot of their debt. So it appeared that they were in compliance with the Maastricht Treaty, even though they really weren't. But hey, more on that when we return on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
And if you just tuned in, we're having our Monday discussion with John Rubino and talking about the fact that there is no solutions. There are no solutions for the Greek conundrum. John, so you remember that Goldman Sachs did all these fancy swaps and everything else to con the rest of the EU into believing that the Greeks and others were actually in compliance with all of the restrictions of the Maastricht Treaty when they actually weren't. Wherever there's evil, Goldman Sachs is bound to be there, right?
Those kinds of fraudulent financial swaps, that's a whole business line for Goldman Sachs. Yeah. I think they have a whole division that specializes in stuff like that because they do it for everybody.
Yeah.
And basically what you do is you just hand off your debt to somebody else in return for a promise that you'll buy it back later. Okay. So when the reporting period ends, you don't have to show that debt on your balance sheet.
Right.
And so you look less indebted than you actually are. Well, that's fraud.
I thought
because
it was.
You lie to somebody in order to get money from them. That's basically what Greece did when it joined the Eurozone. And yet again, there are no Goldman Sachs people in jail for this. Yeah. And so, what can we say about this? That's something that, we've seen happen time and time again where these big banks perpetrate a fraud one way or another or facilitate it and walk away. Goldman Sachs got paid for that. And I'm sure they got to keep the bonuses that they earned for helping Greece lie to the Eurozone in order to get accepted.
That's on a very grand scale, too. That's an international theft.
It's almost an act of war when you think about it. If a company from one country defrauds another major country, I don't know.
There's something, it's like, I don't know how to even describe it because we never lived through a heist like that. That is a heist of epic proportions, and they skate.
Well, I think it's clear that by now, it's clear that most major governments are run by their big banks.
And they must have known about this right? They knew about it.
Or they couldn't do anything about it once they found out.
They just winked. They knew about it, right?
But if you do something to Goldman Sachs over this, then meanwhile, Deutsche Bank is doing equally egregious things in other areas of the financial system, and then you have to punish them. But of course, they're the ones financing your government if you're Germany, so you can't punish them. So it's best just to leave them all alone and let them do what they want to do, I guess.
Yeah, you're right. It's virtually an act of financial war, and you saddle them with saddled all of Europe with, it's kind of like your brother-in-law comes to borrow money and he shows you a certified financial statement from an accountant, and then you find out that accountant was actually in jail when he put together that financial statement. It's absurd. Yeah. It's totally freaking absurd.
Well, you know what is really interesting about the aftermath of all this is that these countries are so indebted around the world that, and huge amounts of debt is very deflationary, because when the debt starts to blow up, you have to get the money to pay off your debts, and that creates an increased demand for currencies, which is deflationary. But anyhow, it's leading to not just zero interest rates around the world, but negative interest rates. There's something like $2 trillion of debt in the world right now that has either zero or negative rates. Right. And that is an absolutely fascinating, unprecedented situation. We've got Sweden and Denmark and Japan and several other countries where negative interest rates are becoming the norm, and it's spreading to the rest of the world. So what does that do to the signaling mechanism of the financial markets when you have to pay to lend?
Very, very bad.
Yeah. So, very, very unprecedented. It's not clear what signals it sends anymore, because if you can get a 2% mortgage, do you take it instantly just because that's the cheapest money you'll ever borrow? Or do you look at it and go, all right, well, the real deflation rate is 3% now, and so the real interest rate on that is actually 5%. That's not such a good deal. And there's a lot of calculation that has to go on that it's not clear that most people are able to make.
They're definitely not.
Yeah. And at the same time, companies, there are now negative interest rate corporate bonds that allow companies to issue bonds and be paid for it. No, they don't have to pay to borrow money. People pay them for the privilege of holding their bonds, and they can turn around and buy back their stock and not have to pay their 2% dividend or whatever. So it's a massively cash flow positive activity there, borrowing huge amounts of money and buying back equities, which is one of the reasons why the U.S. stock market in particular is booming right now. You got all these corporations doing that, and or borrowing at least at really low rates, if not negative rates, and making a really nice spread. See, that's another carry trade.
Right. It really is. It really is. And it's all going to come to naught at some point, for sure. But
so what blows up that carry trade? Is that when the stock market tanks? Because you've bought back this stock and it goes down in value. So you're still stuck with the debt. Yeah, okay. So then in the next stock market correction, next bear market, then that carry trade blows up because all these corporations will have borrowed money to buy back stock, which is now worth 20 or 30% less than what they paid for it.
Exactly. No, it's not going to end pretty. Not going to end pretty. And speaking of debt, so that leads us to your next article, which is if debt was the problem, we're issuing debt at a rapid clip because the whole system, and this gets back to the fiat money system and fractional reserve banking, which requires ever increasing amounts of debt to generate more interest payments to pay off more debt, right? Isn't that the whole Ponzi nature of fiat money? Well, not so much fiat money, because fiat money is fiat money, but really we're talking fractional reserve banking, right?
Yeah, well, there was a McKinsey and Company report that came out just lately where they totaled up all the debt in the global financial system.
Somebody's doing it.
Yeah. And they got a kind of a disturbing result. It turns out that since 2008, who was surprised by this? Yeah. Well, I think people might have been surprised by the number because it's $57 trillion extra debt that we've taken on since then worldwide. And so if debt was the problem in 2008, if that was the main cause of the crisis, then we've actually made it much worse because $57 trillion is several times the size of the U.S. economy. That's a lot of debt for the global economy to take on. And so we have made our problems much, much worse. We haven't fixed a thing in the last 5 or 6 years. All we've done is cut interest rates and borrow a lot of money at the government level and hope it worked out. But it hasn't worked out because we're just now much more deeply in debt than we were to start with. And that number doesn't include unfunded liabilities, which a lot of pension funds at least had back in the last crisis. They didn't have enough assets to cover their projected payouts in the future. And so with stocks and bonds way up, which are the main assets of pension funds, you would think that they would at least be doing better, right? So I did a Google search for unfunded liabilities and found that no, it's not the case. The pension funds of the world are actually more underfunded now than they were in 2008. So their obligations are going up faster than their assets are appreciating. And so the gap between what they should have and what they do have is growing even wider. And so you've got the U.S. government with $100 and some trillion of unfunded liabilities, and then teacher retirement pensions around the country in the U.S. grossly underfunded, and big city public sector union pensions grossly underfunded. So we have all these other problems that are above and beyond the actual debt that we've taken on, that doesn't normally show up in the debt statistics, but is actually bigger than the amount of debt that we report. And so in terms of a recovery, quote unquote, that is going to bring back normalcy and fix the system that almost broke in 2008. But the best and the brightest, our central banks and our government leaders jumped in with both feet and fixed it. That's not what happened. Basically, what we did was just borrow a lot more money and push the problem down the road. And now, statistically at least, in terms of the amount that we owe, the problem is much, much bigger than it was then. So if that was the reason we had the crisis in 2008, then the next one is going to be much, much bigger. It's going to be overwhelmingly big. And I think a lot of central banks and the financial markets in general get this. And that's part of the reason why interest rates are going negative, because the smart money is worrying about return of capital rather than return on capital now. They just want their money back eventually. And so they're going for the safest possible places, which are relatively stable government debt and big multinational company debt. Entities that, in the case of governments, they got a printing press, so they can pay you back eventually, no matter what. And big companies, where their operations are spread out all over the world, they have a pretty good chance of coming through whatever happens in pretty good shape and being able to pay you back. And so you, as part of the 1%, as the smart money, you don't even care if you get paid at all. You just want to be paid back at the end. You just want your capital back. And so you're willing to accept zero interest rate or negative interest rate. You're willing to pay for the privilege of parking your money somewhere. Now, which leads us to gold, which we always end up talking about.
Yeah.
But, it used
more
to be
than ever.
Yeah. Well, it used to be with gold that, it still is. You pay to store it. Okay, so it costs you 1% a year or whatever. And did we talk about this last week, Kerry? I don't remember.
Yeah, we did.
Let's stop it and go on to something else then, so we don't repeat ourselves.
Yeah, well, we're getting close to the end, but the point is that you raised that a lot of this debt is going to blow up. It's going to cease to exist. And who's buying this debt now? But only captive buyers of one sort or another, right? It can't be anybody in a free market buying it.
Well, yeah. Central banks are now buying back 100% of the newly issued debt of governments. Mm-hmm. So that's one thing. And you could kind of call the 1% a captive audience in a way, because they're getting so much money thrown at them by the governments of the world and the big banks that serve them, that they don't know what to do with it. They're buying art at inflated prices in London penthouses and all the rest, and they've still got cash left over. So they're putting some of it in stuff that may not pay them anything, but probably won't cost them anything. Or won't cost them much. And that's, from their point of view, it's not a great deal, but it's probably all they have left. They've already bought all the Van Goghs at record prices, and there are probably no more Andy Warhols available right now. And London penthouses and New York City penthouses are at record high levels. So, in other words, they might cost you something in the future because they could go down. Mm-hmm. But a bond issued by Hershey's, the big chocolate company, let's say, or Nestle's, which is a Swiss company that does have negative interest rate bonds. They will probably give you back your money eventually because they sell to the whole world. They've got operations spread out all over, and in that sense, they're insulated from trouble in any one place. So it's a diversification, but it is not an investment anymore. You can't make any money doing that. All you can hope for is to get your principal back in the end.
And you know what? Sometimes that is enough when you're living in a world in which we're living in, where most debt is going to cease to exist in the next 5 years, in my opinion. And I don't think you'll take issue because based on what you're saying, debt problems gotten much worse and the ability to resolve it, whatever ability there was, is disappearing. Then, hey, just getting your money back is enough in that situation. Just to know that it's in a safe place. You can't put it all in the mattress. You got to park billions of dollars. What do you do? That's really the problem. Any event, we should all have such problems, John, that we just need to put our money in a safe place because we have so much of it. Wouldn't that be a wonderful thing?
That would be a wonderful thing. So much cash, we don't know what to do with it all.
Yeah. We just got to put it, can't put it all in the mattress. The Colombian or the Mexican drug cartel problem. We've bought billions of dollars of every currency in the world. We've bought as much gold as we can. We've got every stock on the big board in every stock exchange, and we still have got too much cash. We don't know what to do with it. So now we're buying negative yielding bonds in every currency. And hopefully that will protect our money. We're not so worried about the government busting us. We're just worried about the government destroying all currencies. Isn't that what it comes down to? Because you've seen the pictures of those drug dealers that they busted in Mexico, and they've just got rooms and rooms full of currency, like pallets full of $100 bills and euros and yuan and you name it. And then they've got collectibles and paintings and everything else. I think you've seen that like on the internet. It's just a mind-blowing sight. And unfortunately they got busted, but they say there's like 35 or 50 homes just like it in Mexico or South America. And that's their biggest problem, isn't fear of arrest. It's fear that all of that paper that they've got pallets full of is going to become worthless. That's their biggest fear. Can you imagine?
Yeah.
That's the world.
And the really amazing thing is that this is nowhere near done. We're just the early stages of the craziness because there's nothing happening now that fixes any of this. It just delays the inevitable, and they're going to have to. So there might come a time, Kerry, when the whole world operates on negative interest rates for a while before it all falls apart. We'll be taking out 1% mortgages, or maybe they'll be paying us to borrow against our house. That'll be cool.
Yeah, well, I don't think it's going to get that far because negative interest rates are only for the wealthy. But you could see a 2% mortgage very realistically. 2.5%. Yeah, I think that's very possible. Anyway, find John at dollarcollapse.com. Buy his book. We got a link right to it on financialsurvivalnetwork.com. Make sure you check out the site. The stories just keep coming in. Then one is just more unbelievable than the next. You really got to check it out. We've got the entire archive of our interviews with John and every other guest up on the site. You really need to check it out. financialsurvivalnetwork.com. Sign up on the mailing list. We'll be having our next webinar coming up very shortly. You don't want to miss it. John, we will talk to you next week.
Thanks, Kerry. Talk to you then.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.